It happened in 2008. Then it happened again in 2019. Every time there's any sort of trouble, these banks go to the FHLB lending. And that's what you're seeing right now. And that's a surefire sign that there's a crisis.
Welcome, Land of Arcadia Economics, to another bi-weekly podcast that I do on behalf of Arcadia Economics. My name is Dave Kranzler, and today I'm bringing back a special guest that I featured in January who happened to predict the bank crisis back then. But first, before we get started, this episode is sponsored by Silver Viper. Silver Viper is advancing their La Virginia project in Sonora, Mexico. You can find them under the tickers VIPRF on the OTC bulletin board market and VIPR.V on the Toronto Venture Exchange. Just to give you a little bit of background on Silver Viper, it currently has a resource of 414.6 thousand ounces of gold and 19.8 million ounces of silver, or a total of 661,000 ounces of gold equivalent. And the market cap is unbelievably just $12 million. And that values the gold in the ground that they've already discovered and have made a legitimate resource estimate from at $19 an ounce. So in my opinion, I cover Silver Viper in my mining stock journal and I invest in it. And if silver continues taking off like it's taking off, I think this stock offers the potential for a 3 to 5 bagger this year. So I wanted to reintroduce John Titus, and I had him on in January. John Titus produces fantastic financial system, central bank analysis videos for his Best Evidence YouTube site. And he also does a weekly podcast with Catherine Austin Fitz. I think everyone knows who she is. And you can find that podcast at thesolaryreport.com. I believe that's the URL, is it not, John?
I think it's solari.com. Yeah.
Okay, solari.com. At any rate, thanks for coming back on. I wanted to bring you on because obviously what's happened since last time you were on has made life more interesting for everyone who follows the markets. Yeah. And I just wanted to give you some kudos because back in January, you identified a specific part of the Fed balance sheet that basically told you there was a banking crisis starting to unfold. And so do you want to kind of elaborate on that? And if you want to show graph one, just by way of introduction to the topic.
Yeah, I'll talk a little bit about graph one. Give me a minute, I'll get to graph one. But to back up, you and I did talk in January, and I was working on a video at that time, which I put out in February, about February 22nd. And I said, we're in a bank crisis. There's a bank crisis going on right now. And what I was looking at, it really wasn't Fed data, it was FDIC data. And the FDIC puts out every quarter, they put out a quarterly banking report, and there were 2 quarters in a row, culminating with, at that time, the third quarter report of 2022, which showed massive increases in Federal Home Loan Board lending to banks. And that's a big canary in the coal mine, because banks, big banks, and really all banks, when they begin to panic and they want to borrow money, they avoid the Fed discount window initially. All right, they because everybody's watching the Fed discount window, and they know if you go to the Fed discount window, you're jonesing, you need a fix, you got a problem. So what they do is these banks tend to do, they'll go to the repo market, or even before that in 2008, they went to the Federal Home Loan Board banks and they borrowed their money there. And that's what I was seeing. And I said, this is a surefire indicator that there's a banking crisis going on. You see it in 1999 or 2000. Back then, it was going on back then. It happened in 2008. Then it happened again in 2019. Every time there's any sort of trouble, these banks go to the FHLB lending. And that's what you're seeing right now. And that's a surefire sign that there's a crisis. And so, yeah, I called the crisis ahead of time. But honestly, Dave, we all know. I mean, I think people who sort of follow the Fed and sort of track the system, kind of know the Fed's ultimately going to have to pivot because we can't have high interest rates. There's too much debt in the US to possibly support high or even reasonable interest rates due to the debt. You can't, if the interest rate is so high, at some point, what ends up happening is the U.S. is borrowing money to make an interest payment, which is mathematically that's the end of the line. That's death. And so it's only a matter of time before interest rates have to go back down. I mean, the Fed has to pivot. And the question is, what's the triggering event? And now it's starting to look like this is the advent. We're in the early stages of a bank crisis that is going to mark the pivot, to be sure.
Sure. Now,
Now, if you,
just to kind of interject here, the what I noticed when I was looking at these graphs, these Fed graphs on Fred, I don't know, a few weeks ago, if you pull up that graph on deposits, I mean,
yeah,
everyone started blaming the current crisis on, a sudden outflow of deposits. Well, deposits have
no.
been flowing out of the banking system for a year now.
Right. This is you've got the line here in black, that trend line there for the last year or so. That's quantitative tightening. And the reason that's happening is that when the Fed, remember when the Fed vastly increased its balance sheet during the pandemic, the way it did that was a little different than it did it during the global financial crisis. During the pandemic, the Fed suddenly was buying assets from non-banks. And remember, it hired
Mm,
BlackRock to help it pick out what assets to buy. And BlackRock sort of engineered this whole thing. They were buying from non-banks. And when the Fed buys assets from non-banks, it increases the commercial bank deposit supply. And that's exactly what happened. So what you're looking at now, that you look back at this graph, is now that the Fed is tightening, it's simply reversing slowly what it did during the pandemic. So the assets went up. That's all, by the way, that's all the Fed buying assets during the pandemic. And now that it's tightening, those numbers are coming back out of the commercial banking system. This pivot here, this started when the two banks failed, Signature Bank and Silicon Valley Bank. And now what you're seeing, that big, huge plummet there, that's different. That's people moving their money. That's people doing what they should have done before these two banks failed. People with north of $250,000, that money is uninsured in their bank. The way to deal with that, if you have that kind of money, is move it out of your bank and buy treasuries. Just park it there for a while. They pay a higher interest rate anyway. And what you're seeing in that graph is people moving money out of their commercial bank accounts into treasuries, which basically means they're moving commercial bank money is being destroyed and it's being recreated in the Fed's TGA account, or sorry,
where do you
in the
think that
treasuries.
money, the money that outflowed prior to March, right? So it was roughly 450 billion, right? Because you had 750 billion.
Yeah,
Yeah. So
right.
where do you think that gently downward sloping money went? You think that also went into treasuries, or maybe, well, didn't go into the stock market because the stock market's been declining?
I think a lot of it, Dave, is those treasuries, as you know, and mortgage-backed securities, as you know, they roll off. And that's what you're seeing there. That general slope down is treasuries and mortgage-backed securities rolling off. They expired, and the Fed simply doesn't renew them. But they're ultimately coming. They came from non-banks, and that's why you're seeing the decline.
The decline in deposits.
Yes, that the
Okay.
decline in deposits is ultimately coming. I did a video. I can't remember the title where I explain the Fed giveth and the Fed taketh away, basically. And basically, when the Fed buys assets from non-banks and it increases the commercial bank money supply, remember the Fed increased the balance sheet by $4.5 trillion, but that's not all it did. When it did that, it bought from non-banks, and that had the effect of replicating that $4.5 trillion increase in the retail bank money supply. So retail
Wow.
bank money supply went from 13.5 trillion to $18 trillion due to what the Fed did. And Mervyn King, the former head of the Bank of England, blamed the Fed, said that's where your inflation's coming from. There's no mystery here at all.
Well, I was
They
just going to
increased
say there's your source of inflation.
bingo. And Mervyn King said as much. But I point out in that video that, the Fed giveth, that's on the way up. Now when they reverse, that money is going to be coming back out of commercial bank deposits. And that's basically what you're seeing. But the way they're doing it is they aren't when they were buying assets before, it's not that they're selling assets now to people who have their money in commercial bank accounts. It's that they're letting those instruments roll off their balance sheet. So that's why the slope is gentle. The steep slope, though, is coming from people panicking and getting their money out of banks and into treasuries.
Right. So, speaking of that, if we go, well, yeah, if we go to graph two, what you said was what you noticed was
Yeah.
happening in January, accelerated in March. It's kind of
Yeah, that's what's once the banks fail, that's there. That
right, but
300
and
billion.
actually, you started going off a cliff there,
Yeah.
or the amount of deposits spiked up. This is the Hemingway's how do you go broke, right? Uh,
Yeah, it is.
Slowly,
Right.
then suddenly. But
Yeah.
what's interesting is that cliff started happening probably about a week or two before the SVB signature crisis sparked the general bank crisis. So someone knew what was going on, or several entities knew what was going on, and got spooked, and then it just sort of avalanched.
Yeah, the SBF was that failure was in November of 2022, right? That's when
SVB.
FTX.
Oh, FTX, yeah, yeah.
Yeah, that
See,
wasn't.
I agree. I think FTX, aside from the massive fraud going on there, that was a warning flare that there was something deeper going on in the
Yeah,
banking system.
right. That was a canary in the coal mine early on. Something was way
You
wrong.
could almost say maybe it was the Bear Stearns of 2022, 2023.
Yeah, it could be. Although I really think Silicon Valley Bank and Signature are the Bear Stearns today. But we can argue that all day long. There
Yeah,
were
it's
warning
it's
signs
it's
back in
just a matter of
2001 too.
semantics. Yeah,
Right. I think we would agree, you and I, that we're in the early stages of a crisis. We're not through this by any means.
sure. We'll get to that in a second. So, and then in the midst of all this, and it's been well pointed out on social media, Zero Hedge, whatever, um, over the last, well, while the peak of what was going on with SVB and the regional banks was occurring, all of a sudden the Fed balance sheet over a 2 week period popped up $400 billion. If you
Yeah.
want to, if you want to show graph three, it's my lovely
Um,
graphics work.
yeah, let me
This is why
let
I'm
me
not a
go back.
graphic artist.
So let's just cut to that graph. You did this graph, right?
Yeah, blame it on me.
Um,
This isn't. John would do a much nicer graph than this.
this is it's good enough. It gets the point across. And so this is the Fed's balance sheet, and they've been quantitative tightening for a long time. And now all of a sudden, when they have these bank failures, and they open up these new programs to buy assets from the bank. Notably, they are buying assets at over par, right? Or they're buying the assets at par. They're buying them
Discounted
over.
assets they're paying par for. A lot of these
They're
things are
paying
trading at 80, 85 cents on the dollar. And, they're government backed
right,
securities of long duration, and they're 15 to 20% underwater
right,
on the bank's balance sheets. The banks put them
right,
up as collateral, but they get cash as if they're putting up collateral at par.
right. And the Fed has never done that before. And so the people who tell you that this is not a bailout, they're simply wrong. They don't know what a bailout is. They don't understand a bailout. A bailout to me is you have a set of rules that everybody knows in advance. You get an outcome that you don't like because your cronies get hurt, and now you change the rules to get a different outcome. And one of the ways they've changed the rules is what you just said is they're paying par for assets that aren't worth par anymore. They're worth less. The Fed has never done that. They've changed the rules. It's a crony system. Another way they bent the rules is they reimbursed people. They saved all their cronies who had way too much money in these banks. It was uninsured, and they're reimbursing them at full value. So no problem. You had $1 billion sitting in the bank, and basically all of that was uninsured. No problem at all. We're gonna make sure you have your insurance and you're made whole. Again, it's just changing the rules after the fact. It is a total bailout. Period. Full stop. The people telling you otherwise don't know what they are talking about, or they're lying, Those are your two choices.
I agree 100% with that. So going back to the graph three, beautifully
Yeah,
designed by me, we can see, there's really what the quantitative tightening was, is it was minuscule. It didn't take much
right. It's from
of this
here to
quantitative
here.
tightening to cause what happened in
Right.
March. That, along obviously with
Exactly.
the rapid interest rate hikes, but is what we're
Right.
seeing, that bounce with the green arrow, is that the Fed's pivot that everyone's eagerly begging for?
I think basically it's the very beginning of it. I tell you what it reminds me of, Dave. To be honest, it's very similar to quantitative easing during the pandemic started really full tilt boogie in March of 2020. And if you look at your graph,
Yes. And
let's
actually,
just
you
cut
could
over.
argue that it really started in September of 2019 when they went into
Actually,
those
you could really
temporary
argue that it's
permanent
you
repos.
could you could really argue that it started in 2019. So your graph only goes back to 2020, or that's really
Right.
March right there.
That's right.
Okay, I want to cut to a graph of, let's go farther back in time, of the Fed's balance sheet, and here you go. This
Yep.
is right from the Fed's website. Your graph was started about here, and that's what everybody thinks. That's QE during the pandemic, but actually, as you point out, the repo crisis back in September of 2019 is here. So that's kind of your canary in the coal mine. I think that what happened in 2019 is kind of what we're seeing here. We're seeing the very beginnings of a big, big problem. And remember, the canary in the coal mine back in 2019 here, the repo crisis, led into pandemic. Oh my God, I can't feel my legs, pandemic. Right? So that's what I think we're looking at here with your, and to cut back to your graph. Um, let's go back to your graph. Get out of that. Cut over here. There we go. That's, I think we're seeing there is the very beginnings of a big problem. I
What's
think, like,
interesting
again,
is,
we're in the early stages of a major crisis.
yeah, what's interesting is, and this just may be coincidental, but so they started off with those temporary repos that went from overnight, remember that,
Yep.
to a week long, then 2 week long, then they extended them out a couple months, right?
Yep.
I wrote about
Yep.
that back in September and October on my blog, and I referred to them as the temporary permanent repo operations. And I basically said this is QE in disguise. Now, the
Yeah.
slope of that line,
That's exactly right. It's QE in disguise.
yeah. So the slope of that line is a lot more gradual than the slope of the line from this latest, what we think is probably a pivot. So to me, do
Right.
you
In
think
other
there's any
words,
correlation with the degree of severity of what's going on now versus then?
I think it's a very similar scenario. In other words, you're talking about, like, what you're saying is basically now it looks like that's a big spike,
Yep.
but guess what? Back in 2019, this looked like a big spike too. But it stopped looking like a big spike once you saw its bigger brother show
Oh,
up on the scene.
that's true. It's a
You see
question
what
of
I mean?
scale. Yeah.
Yeah, it's just a question of scale. And so I think what you're seeing there in your graph, with it looks like a spike up, it's going to look like a blip in by September or October or the end of the year. In my opinion, I think that's what's coming. I think it's a tremor you're seeing. Like, you're seeing a tremor before the seizure hits.
So one more quick thing, and then I want to just quickly transition into gold.
Yeah.
Um, I remember in January, I asked you if you thought the Fed would pivot this year, and you, along with everyone, thought it would be, myself included, if they were going to pivot, it would probably happen late summer, early fall.
Yeah.
All of
Right.
a sudden, we have what looks and smells like a pivot and feels like a pivot, right? So it probably is a pivot, borrow from the duck analogy, and
Yeah.
or duck metaphor, I guess. An English major, I should know this stuff. Um,
Yeah.
so, what do you think it says, if this is indeed the pivot or the start of the pivot? What do you think it says about the severity of what's going on? I mean, this is happening half a year earlier than most of us so-called experts expected.
Yeah. Well, I mean, remember in 2008, we had Bear Stearns in March before we had Lehman Brothers in September. So, and again, as we just saw, we had the tremor happen in September of 2019 before the pandemic QE really started in March. In retrospect, there's always like an early warning event, a canary in the coal mine event, which in retrospect you see kind of kick yourself for not seeing the signal. I think that's what we're looking at here. So whether you really want to call it a pivot or not, the trouble is back, and it's back in a big way. Whether it's a formally known as a pivot, or whether it's a tremor or a canary in the coal mine, we're back. We're in big trouble now.
So just to add to that, we don't have to unpack this because we're probably running out of time, especially since I don't have the pro version of Zoom. But what's interesting is you can also throw Credit Suisse into the SVB signature
Yep.
FTC portfolio of bank blowups. And it
Yep.
just kind of occurred to me that everyone's focused on what's going on with the regional banks in the US. And Credit Suisse's, except for occasional news tidbits like bonus cuts for the poor Credit Suisse employees, um, Credit Suisse has been kind of moved out of the limelight, which I think is
Yeah.
interesting. And I also think it's something that they probably wanted to have happen because Credit Suisse is many multiples bigger than several of these
Right.
Fed regional bank, or I mean, not Fed regional banks put together in the U.S.
Yeah, well, it's interesting because to me, the failure of Signature and Silicon Valley Bank, these aren't really regional banks. They're calling them that to minimize the fact and get away from the fact they're both top 30 banks in the US. In other words, if you rank the
Mm,
banks from 1 to 4,630, okay, these two banks that failed, they're in the top 30. So really in the US, you have 4,600 banks sitting out there, and you're telling me that two of the banks that failed are in the top 30? You think that's a coincidence? These are huge banks. They're just
yeah,
not as huge. What they're doing, really, these guys, the Fed, they're expanding the scope of too big to fail to include the next rung down, which is the rung from, say, the top eight or top six down to the top 30 or 40 or whatever it is. And it's the same thing. They're pushed, like you say, they're pushing Credit Suisse, which is a too big to fail bank. It is a GSIB, a global systemically important bank. They're pushing that out of the limelight, as you say. At the same time, they're trying to deflect attention away from the fact that Silicon Valley Bank and Signature Banks are both huge banks. They
yeah,
both have well north of $100 billion in assets.
that's right. And also, very wealthy, well-connected people would have been hurt by the blow up if the Fed and the
I'm
Treasury didn't
making a
step
video
in.
on that right now, man.
I can't wait to see it. So, real
Yep.
quickly, we can conclude that this is just getting started. And I personally think this is extraordinarily bullish for gold and silver. And clearly the prices have been rising quite a bit over the last month. And I think they have a long way to go. But there was an interesting report out. The World Gold Council issued their latest report on central bank. I think it was just central banks generally, but it showed that the Eastern Hemisphere central banks have continued into this year buying gold at the record pace that they bought gold in all of 2022. Why do you
Yeah.
think they're doing this?
I think they're setting up a situation where they say, look at our system. Our system is backed by gold. Your system isn't. Our system is honest. Your system is dishonest. Every time the Fed or the FDIC or anybody else makes the news, it's because they violated the rule of law. In other words, we just talked about how they change the rules when their cronies get hurt. They just change the rules. They dispense with the $250,000 limit set by the FDIC. The Fed starts overpaying for assets for the first time. They just change the rules. They bail out their friends. They freeze Russian assets willy nilly. There was no due process there. Who dubbed or deemed Jerome Powell king of the world, where he can just override the rule of law and decide whose assets get frozen and whose don't? And the rest of the world watches this and says, the U.S. doesn't have the rule of law. The U.S. is run and ruled by criminal cronies, and our system is honest. Our system is backed by gold. And I think in their system isn't. They haven't been backed by gold for over 50 years. And there's a reason for that. These people are fundamentally dishonest running the system. Our system is safe. And I think that is what you're seeing with the movement of gold to the east. They are setting up a situation where they can say, you know what? We should be the new world reserve currency, not that tattered dollar.
When you say our system, you're referring to the Eastern Hemisphere
Yes.
alliance of block of countries that are all allied that include the BRICS and the SEO, and there's some other umbrella organizations in there. I
Yeah.
agree, and I would just add to that. I also, because of what you just laid out, the reasoning, there's just a growing massive distrust of the U.S. dollar, and clearly the Eastern Hemisphere block of countries, along with some of the Southern Hemisphere ones, it would seem to me that they've been slowly trying to wean themselves off the dollar, and now the pace is starting to accelerate, and they're not. It's becoming more obvious to more people, and there's clearly lost confidence in the dollar as the reserve currency for the reasons you said. Well, and also because the Fed has been the most prolific printer of money, or should I say current reserve creation, since 2008. And that's causing the inflation. And I think at some point, these countries are going to issue some type of currency that will be anchored to gold or maybe a basket of commodities.
Right.
Any thoughts
I
on
mean,
that?
I think that would be a reasonable surmise. They're not buying this. They're not buying gold in the volumes they're buying it just for the hell of it. There's a purpose behind that. And I think, well, one plausible explanation for what's going on is what you just set forth, is they're setting up a system where they go back to basically the pre-1971 US system, where the currency, they're basically their debt-based monetary system. At least it's debt-based, but it's backed by gold. And
Right.
that's what ours was before August 15th of 1971. I think that's where they're headed to. I think that's a completely reasonable explanation and probably what's going on. But because it's in the future, I don't know. Maybe it happens, maybe it doesn't. I would bet though that that's what's up.
When you say pre 1971, I think some people are referring to that as a Bretton Woods III, just kind of euphemistically, just to kind of encapsulate what they're doing. They're doing a new currency agreement that'll establish a new reserve currency that most of the world will use.
That probably is that would be my best. That's my best guess as to what's happening. I agree with you.
All right, so John, we need to wrap this up. Again, I really appreciate your time. You were generous with it. You were patient with my media incompetency, my Zoom media incompetency. Can you tell the audience where they can find your work?
Yeah, I'm pretty much, you can find all of it on Best Evidence. I have a number of channels. I have a YouTube channel called Best Evidence. Also, Odyssey, BitChute, and Rumble. I have a Best Evidence channel there, and that's what I do. I'm not on Twitter, not on Facebook. I'm not on any of this other stuff. And I don't make that many videos. I've only made 33 videos. The one I'm working on now will be number 34. I like, my model is more of the sniper. I'm not a confetti video producer. I pick my shots, and when I take a shot, it tends to be pretty good. I'd like to think.
Well, thank you. And I'll just add to that, his videos are worth their weight in gold. All
Thank you,
right,
Dave.
everyone. The next issue of my mining stock journal, which John receives, it'll be come out today after the market closes. And I have a couple of companies that aside from Silver Viper, which I didn't update this week, that I think offer the potential for 3 to 5 baggers this year, extraordinarily undervalued junior mining stocks. And with that, until 2 weeks from now, at some point, we'll have John back on, get an update on the bank crisis. But until next time, try and enjoy what you can while you can, as much as you can.